What is up, everybody? Logan coming at you guys with another video today, and we got the Notre Dame polo on because they destroyed Navy this weekend, and we're looking good this year. So super excited for the football season to get rolling. But today we're going to go over just the big winning streak and finally getting out of that roll that took us about 4.5 weeks in total, which is pretty typical, right? Anytime I'm faced with a roll that I'm not able to get out of within the same week, that trade actually ends up turning into about a month to a month and a half long. And we were able to hedge, end up closing the trade for a $3.90 debit. So $3.90 debit per contract, which can be easily made up in 6, 7 to 8 trades. And then also, if you are new here to this channel, we do have the amplified investing trades here. This is everything I've taken with the Discord. So if you're new to the channel or have ever considered joining the Discord, we are up to about trade 154 right now, as you can see. We did try to put a trade on Friday, but we missed that fill. So if you're either new here or if you're one of those internet haters who doesn't believe what I say or doesn't think we're actually trading, you can go through every single piece right here, spend your entire evening, week, maybe month, micro analyzing everything, go and check every fill if you want to. But you can go check the link down here as well. So I wanted to make sure to show you guys this as well. So that'll be down in the description. So this is one of the members of the group, Tyler Alizorn. He's actually been super active. He does a lot of work on his own as well. But I kind of talked to him beginning of this year and early last year on what you should expect when you trade credit spreads, right? And we have this actual return versus expected return. And this is his goal for the year and where he's at this moment. And I actually drew a picture a little bit ago down here, posted his actual return for the year and how well he's been doing. So thanks, Tyler, for sharing. I really do appreciate that. But I do want to mention that as we're getting into this video. We take a look at the SPX today. So we're kind of in a weird spot right now, right? We have that our major supports on the ES are 44.25 and 44.05 with our resistance currently at 44.60. The reason I say that is because that lines up with the 21-day. And we have the 21-day up here where we kind of started selling off earlier, right? This is on the ES about that 44.55, 44.60 range. And then we're trying to attack that again, right? Had that sell off earlier, didn't like it, and we pop back up to it. And it looks like we're trying to sell this a little bit. So right now we should expect a lot of chop just because we're in between those levels. But once we get a break one way or the other, we'll have a little bit more of a setup going. So today I'm kind of eyeing up the call credit side just because overall it looks like, we're still underneath the 21. And until we break back above that, then I'll get a little bit more bullish. But I'm pretty neutral when the strikes are where they are now. The VIX as well. Another good thing to pay attention to, we're coming right into 15. 15 is one of the major levels on the VIX. If we go over the last few days, maybe the last month, you guys can see a couple times we spent time around 15. We did it back here, and it kind of has held up with support, right? And then you would expect the S&P to go the opposite direction of the VIX. So if the VIX does continue to head up from here, we could head back up to about 18. So for now, until we break below 15 on the VIX or break above 44.60 on the ES, I'm going to be a little bit more neutral to bearish. And we have had a nice 70, 80 point rally in the last couple sessions. So we should expect that to chill out a little bit. So not really fighting the trend because, like I said, we're above the 10-day, but we're below the 21-day. So there's just a lot of chop to be expected. Last couple of trades that we did, though, we've used that expected move math, as I can show over here. This was for today's day, and we're right about the top end of the expected move band, right? 44.05 was that previous close. And if we come back over here right at that 44.35, which almost acted as resistance as its own, right? Like I said, we stay within the expected move more often than not. So I like to place trades outside the expected move and then allow the market to do its magic while also staying as focused on being on the right side of the trade as possible, which we do with a lot of our moving averages and understanding price action, right? Gap up or gap down. We actually did gap up today. If we go look at the Logan's call out tab, I tried to place this trade, but we didn't get filled. Like I said, that market still loves that 44 level. And it's holding support very well. And Jerome Powell didn't come out with anything crazy with the Fed summit last week. So overall, like I posted what happened last year around that time and a couple other, factors for why we fell so quickly last year. But we missed the fill here. Some people end up filling for like 45 cents and 50. I did not get in. I just let it sit, but we would have had another winning trade if we got filled because today gapped up and has been green all day. So just identifying how to be on the right side of the trade is hands down one of the best and biggest factors for becoming a successful trader. That's really it, right? Like if you were to take a put credit spread or a call credit spread for one day out, it's a great way to see how good you are at determining where the market's going to go in the short term based on your indicators, and then understanding how to manage risk if it goes the other way. If you're on the seller side, you can do very well because you're actually overnight, those contracts are going to get crushed by volatility decay as well when you're out of the money. And then every day you wake up, those trades can expire worthless. So that's why I kind of like that 0 to 1 to 2 DTE time frame, because while everyone else is trying to buy options, I would rather sit there and sell them. I get to be the casino. I get to make money over time. And that's also how we're on such a massive win streak that we've been on. We're able to manage the losers, keep them small, and keep our profitability on the upward slope. We have no open trades on at the moment. We're actually going to be placing one this afternoon around 2:30. I'm leaning a bit bearish, but if we do start to break out of these resistance zones, I may flip to the bullish side. 15, we talked about that. 3 to 5 days of green or red. We talk about that a lot in all the other videos where this market likes to move in the 3 to 5 day time frame. And we really haven't seen too much, right? It's been a lot of chop. So expecting a big move to happen soon, but it is also hard to not want to get bullish after you've seen a 200 to 250 point reduction in the S&P in the last month. Hard to not want to get underneath that, right? Since we're generally always heading up in the stock market over time. Back to the checklist, where our levels, we did just go over those. Sizing, I like to size with 6% of the portfolio because that allows me to not get too emotional with a trade. And you can really stack up and get to that 50, 60, 70% return by the end of the year if you're doing everything the right way. Trade timing, we take these trades in the afternoon around 2:30 because that gives the market enough time throughout the day to go to your support that you're testing, go to the resistance levels that you're writing down, testing, using for your levels, and see, does it respect the price? Does it respect that level? Like, is my 44.25, my 44.05, and my 44.60 on the ES, are those legit levels to follow, or are we just going to slice right through it? Choosing strikes, I like to do 2 times the expected move if I can get that. Just makes me feel even more confident in my trade, especially if I'm on the right side. Risk management, we do a lot of rolling, right? Rolling contracts is the way I like to manage. And then de-risking, after we do a little bit of hedging, take a smaller loss than we typically would. And then we also don't have to worry about hard stops and anything too crazy happening because we're sized so properly. But your expectations, like I said, be realistic with what you're seeing every day. And then those small wins just add up time after time again. And Vance and I are also doing an updated video with some nice graphs to show you guys exactly how the P&L looked on the year, because he's just a wizard with it, and what we should expect moving forward. So I do appreciate you guys making it this far in the video. If you guys have yet to leave a like, comment, or subscribe, I'd really appreciate if you did that now. And I will see you guys in the next video.